Welcome to the Spot On Insurance Podcast, brought to you by ILSA, Insurance Licensing Services of America. This is Ted Tavares.
And this is Arlene Tavares, coming to you from beautiful Puerto Rico. I'm so excited because today we'll be exploring the latest innovations and industry trends.
But before we begin, please remember to click on the subscribe button so you don't miss a single episode. And now, here's our host, Doug Foresta.
Hello and welcome to Spot On Insurance. This is your host, Doug Foresta. With me today is Donald Riggin. He is the president of the Art of Captives, LLC, a consultancy specializing in captive insurance feasibility and implementation. And we are going to be talking about captive insurance compliance issues. So first of all, Donald Riggin, thank you so much for joining me.
Oh, it was my pleasure. Thanks, Doug.
Why don't we start with, first of all, since we are talking about captive insurance, can you first start with what is the definition of a captive insurer?
Absolutely. A captive is an insurance company. It's a real live insurance company that is owned by non-insurance companies. For example, the Fortune 500, each of which has a captive, sometimes multiple captives. So that is about as fundamental a definition as you can find. And there's a lot of reasons why captives are formed, but if you're looking for a straight definition, that's it.
And I know that my understanding is there's been a proliferation of captive domiciles. Is that correct?
Yeah, let me talk a little bit about domiciles. A domicile is a jurisdiction wherein captives are licensed and formed. There are about maybe 30 states, U.S. states, are considered captive domiciles, and a couple of hundred countries, offshore countries, are also. And what constitutes a domicile is that it has separate rules. It has specific legislation that allow for a non-insurance company to own an insurance company, obviously, which is a captive. And the biggest deal there is the amount of capital required. Usually, if a commercial insurer, pick one, Travelers, Hartford, any one of them, when they make a application to be licensed in a state, the state says, well, you have to have $20 million worth of paid-in capital, and it has a load of other regulations. Captives don't have to do that, thankfully. If they did, there would be no captives. Generally, a captive's capitalization is, the minimum is $250,000, which is a whole lot less than the commercial insurers. But captive domiciles have been growing steadily over the years. As I said, there's about 30 states that have them now. The problem with that is that other than the core states, Vermont, South Carolina, Washington, D.C., Hawaii, actually, aside from the core states, there are so many states that just want to get in on the action, and they don't really have the infrastructure, the service infrastructure set up yet to do this. So as a consultant, I steer clients away from the new domiciles because they're just too new. They don't really, I don't want to say they don't know what they're doing, but they're green.
Well, that actually brings me to a point I was going to ask you is,
sure.
When you're choosing a jurisdiction or a domicile in which to form a captive, what are some of the things? It sounds like one of the things is maybe experience.
Yeah, absolutely. Yeah, the infrastructure, the service infrastructure, and by that I mean the attorneys and the auditors and the managers. Those are the three main service providers in any domicile. The manager is usually okay because any manager really is in multiple domiciles. So if you have manager ABC in Vermont, for example, they also might have an office in Idaho or Montana, which are domiciles. But the auditor and the attorney are specific to the domicile. They must live there. They have to be residents. And so the whole idea of a captive is, it's easy to see on the outside, to generalize what they do and why they're there and who uses them. But the nuts and bolts underneath the cover, so to speak, are very different from anything anybody else has done. It's a little closed world, so to speak, from a regulatory standpoint. But that's the thing. I mean, if you want to go the safe route, and you're forming a captive for the first time, I will always never hesitate to recommend Vermont, South Carolina, or Washington, D.C., and if you're on the West Coast, Hawaii. Hawaii has been around for quite some time.
My understanding is Vermont actually had a stronghold for captives for a while. Is that correct?
Oh, absolutely. Yeah. Vermont started in 1981. And back in those days, captives were generally only the province of large, very, very large corporations, Fortune 100 corporations, because they needed that kind of critical mass. The whole idea of a captive had been around since the 50s, but it had not evolved into the flexible tool that we know it today. In 1981, it was still, the idea was you've got to have a ton of premium, how much, $5, $10, $20 million of premium to do this thing. So Vermont came along and said, and basically wrote the first real legislation, captive legislation, and they've been updating it every several years since then. But they came along and they said, smaller companies can do this too, and here's how. So they really are the pioneers in this business.
Now, you had mentioned about legislation. Of course, the show is about compliance.
Right.
Can you speak a little bit about some of the unique compliance requirements for captive insurers?
Sure. To try to get one thing off the table, they're licensed. The captive needs to be licensed, but that's a very minor part of the compliance piece. Compliance exists in two areas: regulatory in the domicile and tax at the IRS. For an insurance company to be an insurance company, IRS rules that definition, and that means that there must be risk shifting and risk distribution, just like a normal insurance company. So if you pay a premium to the Hartford, for example, the Hartford has 10,000 clients that look just like you, and they have tons of capital to back that up. You pay your premium, and they then share parts of your premium with the rest of their clients. That is part of the definition of a captive. The IRS has never come out and said, here is what an insurance company is. What we have to do there is look into the case law and so forth. But that's what a captive's all about. You have to be a real insurance company. So once you satisfy being a real insurance company, then you have to assuming that's the case, we go back up to the regulatory arena, and you have to be, as I said before, licensed. There are solvency requirements. And now this is an interesting part. Solvency meaning how much capital you need for how much premium you write. Because I'm not sure if everyone knows how insurance companies operate along these lines, but you have to have X amount of capital to be able to write Y amount of premium. So usually in the commercial arena, the ratio is maybe 2-to-1, 2 parts premium, one part capital. Captives also are required to meet solvency regulations. But they're much less strict than commercial insurers. So usually in the first year, a captive will be required to have, say, 5-to-1 ratio, 5 premium to one capital dollar, which it's it makes sense to do that. The other thing is the financial statements. Regulators require every year audited financial statements, and it used to be that these financial statements were just kind of afterthoughts. Way back in the old days. Well, these days they must be audited by an auditor that has been accepted as a service provider in the domicile. Every domicile service provider is approved by the regulator. So if you're a client and you want a captive, and someone such as myself will do a feasibility study, and we'll go to a domicile. Let's say we go to Vermont. We will then choose a list of service providers, auditor, and sometimes an actuary is involved in that. Usually the actuary is not part of the domicile, but sometimes. Auditor, attorney, and manager. And all three of these service folks have to be approved by the domicile regulator. So that's a piece of compliance that helps the new captive owner and continuing captive owners to feel safe or comfortable that the people they're dealing with haven't just got off the boat, but just jumped off the boat and decided to set up shop in that domicile. So they are subject to accreditation standards within the domicile. They're subject to audits. They have to make sure, the domicile must make sure that these folks know what they're doing, and they continue to do it based on expectations.
Spot on Insurance is sponsored by ILSA, Insurance Licensing Services of America, America's premier insurance licensing experts. To learn more about ILSA and the services they provide, visit ilsainc.com. Let's talk about the role of agents and brokers in captive insurance. Can you say a bit about that?
Sure. There is a myth that says that agents and brokers pretty much go away when a captive is formed. If their client forms a captive, then the broker or the agent has nothing to do. That is patently false. The agent and the broker are very, very involved in the captive. At least they should be. And if that client's broker isn't, then they ought to find another broker. The brokers have the relationships with the regulator and with the captive service providers. Usually, the broker, unless it's a consultant such as myself, but the larger brokers will act as the quarterback for captive formation, as well as captive maintenance over the years. So, agents and brokers have nothing but good things if their clients go into a captive. Of course, they have to be licensed in their jurisdictions, but there's no regulation or no licensing requirement within domiciles that say that a broker or a consultant or an agent has to be licensed. They bring that with them.
So I understand that the disadvantages to being a captive are the large upfront financial investment and the fact that it's not as easy to get in and out of like when you're purchasing insurance from the marketplace. But what other disadvantages or advantages do you see? Well,
clearly the biggest disadvantage is a reduction in cash flows, meaning that the capital must be paid on day one, and whatever that capital is. So if we're talking about a 5-to-1 premium to capital ratio, and let's say that the premium is $1 million, the capital and the premium must be paid on day one. Usually, what's happening is that the client is moving from a large deductible arrangement, wherein they don't pay premium, they pay losses as they occur, which is very good for cash flow because they're not parting with the money until the losses occur. In a captive, though, they have to gather up all the money that their actuary thinks is going to be paid out based on that policy year, and that becomes a premium. that and expenses become a premium, because regardless of what insurance venue we're talking about or insurance vehicle, there's only two things that make up a premium, and that is losses and expenses. So what we have here is a situation where all of the losses that the actuary projects will occur from that particular policy year, all of that is brought together. Now, that creates a tax deduction that wasn't available before. But still, from a cash flow standpoint, that can be a big downside, because folks don't want to have to shell out $1 million of premium and $200,000 of capital right out of the box. So one of the rules is, I say rules, but one of the rules of thumb, I guess, is that the company cannot be cash poor. You need a fair amount of retained earnings to be able to devote to this. But when you do, then the downstream benefits can be significant. But getting in, you need a fair amount of cash. Getting out is a whole other story. What you're doing, again, you are a real live insurance company. You're not a self-insured company where you just put money aside. You're a real live insurance company. You're regulated in the domicile. You can't just walk away from your captive. The captive must be either wound down, or there are ways to sell off the liabilities, depending on how long the captive has been around. So, if a captive has been in business for 5 years, and the line of insurance has a long tail, meaning that it takes multiple years for the claims to pay out, then you potentially have a lot of liabilities sitting there that the captive will be able to continue to pay on a wind-up situation, whereas they would then just stop writing business, stop placing business into the captive, and then just let the business run off.
Can you say a little bit, too, about U.S. versus offshore captive domiciles and the difference between the two?
Captives began offshore. They began in little countries in the Caribbean, which, of course, everyone knows. Cayman, the BVI, good grief, there's Nevis, Barbados, Bermuda. Now, Bermuda's not in the Caribbean, but Bermuda is the largest captive domicile outside of the U.S. They were the first ones. Now, if we put Bermuda aside, Bermuda is a special case because they started this whole thing back in the 60s, basically. And they set up a regulatory regime that was at the time meant to be very stringent, because their attitude was U.S. companies, especially public companies in the U.S., we're not going to come out to our little island here and place their insurance business and set up their insurance companies, their captives, if they perceive us to be lax in regulatory issues. So Bermuda really became the model for just about every domicile that came after it, except for the fact that there are lots of other offshore domiciles that took the opposite approach, the opposite tack, so to speak. They said, well, there might be a lot of companies that want to make sure that the domicile has stringent regulation, but there are lots of other companies that don't want to see that regulation. They would rather come in and be lightly regulated, have a good amount of secrecy, so that nobody can come in, especially the U.S. government, the U.S. tax authorities, can come in and demand to see their records. So that gave birth basically to various domiciles that I mentioned earlier. Cayman used to be that way. Cayman is now much more heavily regulated, but it still is more open to less conventional types of business. And that's another reason, or rather, that's another difference between onshore and offshore. Onshore, the domiciles tend to be pretty strict. You've got the standard insurance coverages: general liability, property, workers' compensation, automobile. And if you vary from that, then a lot of the onshore domiciles simply are not going to go there. Offshore, they will almost do anything offshore as long as you can convince them that you know what you're doing. That's huge. That's big anywhere you go. I mean, regardless of the domicile. But if you're offshore, you have to convince them that you have a handle on this business. You know what you're doing. You know why you're doing it, where the funds are coming from, and you're willing to fund and capitalize the captive correctly. Aside from that, if you're offshore, the sky is almost the limit. So I think the major difference between the two, onshore versus offshore, is offshore being much more flexible, much more willing to entertain offbeat business, like third-party business, for example. If somebody wants to set up a captive to write warranty coverage for, you name it, some sort of manufacturing operation, let's say, you can, offshore is where you go for that. You can probably do that onshore, but probably not. They probably. It's very difficult to do that onshore. So the differences are, if you want to be real safe and you've got a board of directors that doesn't want to see its money go to some island somewhere, then you stay onshore. If you have another kind of board of directors that says it just wants the most, the least amount of regulation and the most amount of flexibility, you do go offshore.
My guest is Donald Riggin. Finally, I want to ask you the question of how do you help people? And I introduced you briefly, but can you explain to our listeners a little bit about what you do and how you help people related to this topic? Sure.
I'm a consultant. I'm an independent consultant. I do captive feasibility work, meaning I will look at your set of circumstances, and we will go through a rather extensive interview process. We'll run the various financial models, and we'll talk about everything that makes up your company, and we'll figure out whether or not it makes sense for you to own a captive. Sometimes it's very clear that no, you shouldn't own a captive. Even though you want one, and even though, a lot of folks think they're sexy, you talk about Bermuda and Cayman as offshore domiciles. People want to go to those places. And sometimes it becomes very obvious based on the face of it, the facts on its face, that a captive makes a lot of sense. Based on some big, rather high dollar issues like lack of the ability to find coverage for an important line. What I try to do is be as thorough as possible and find as many pros and as many cons as I possibly can to see that the client, whether or not the client it actually makes sense to do this. I don't have a stake in whether or not they do it. So I get paid for this analysis, and if they do it, great. If they don't, well, it doesn't matter to me. My job is just to make sure that they are going into this with their, if they do it, with their eyes open.
And how can people reach you?
My telephone number is 978-594-8762. And my email address is artofcaptives@icloud.com.
Thank you so much, Don Riggin. Thank you for joining me today and sharing your words of wisdom.
Oh, well, I very much appreciate it, and thanks for the opportunity, Doug.
Thank you.
By the way, our show notes and bonus resources can be found on spotoninsurance.com. Subscribe now so you don't miss a single episode.
Thanks for joining us. And don't forget, we'll be answering this week's podcast questions at Spot On Insurance Facebook Live, Fridays at 11 a.m. Eastern.